Here is the thing nobody is saying out loud right now. Bitcoin did not dump because of Trump. Bitcoin dumped because of what was already sitting underneath the market waiting to explode, and the tariff headline was just the match. If you don't understand that distinction, you will make the wrong decision at exactly the wrong moment. So let's fix that right now. I'm going to show you the actual machinery, the derivative structure that made this collapse mechanical and not fundamental, the capital flow model that tells you where fair value actually sits right now, the statistical framework that shows you, with real data, where we are in the distribution of this sell-off, and the institutional psychology layer that explains exactly who is selling, why they are selling, and critically, why they are almost done. This is not a recap. This is the analysis you need to make a rational decision in an irrational market. Let's go. Bitcoin is sitting at approximately $64,000 as I record this. The all-time high was $125,000 in October of last year. That is a 47% drawdown. And if you entered anywhere between $80,000 and the peak, you are sitting on a loss that does not feel like a normal correction. It feels like a catastrophe. I know that. And I'm not going to dismiss it. But I am going to show you that what you are feeling right now is one of the most precisely engineered emotional experiences in financial markets. It is not random. It follows a pattern. And once you see the pattern, the feeling loses its power over your decisions. Here is what happened in the past 72 hours, fast. On February 20th, the Supreme Court struck down Trump's sweeping tariffs imposed under the International Emergency Economic Powers Act, 6-3 decision. Bitcoin briefly popped above 68,000. And then within hours, Trump signed a new executive order reimposing tariffs at 10% under Section 122 of the Trade Act of 1974. By Saturday the 21st, he raised that rate to 15%, the statutory ceiling under that law. Asian markets opened ugly. Bitcoin slid to 64,300. Ethereum dropped below 1870. Solana, XRP, Avalanche, all down 6 to 9%. Total crypto market cap, $2.23 trillion. Gold climbed 2%. That is the headline sequence. Now forget the headline sequence because it explains almost nothing about what actually happened mechanically. And the mechanical story is where all the real information lives. Let's start with the derivative structure, because this is the part of the market that turns a 5% news move into a 12% cascade and nobody explains it properly. In the weeks leading into this move, open interest in Bitcoin perpetual futures was elevated relative to spot volume. What that means in plain language is this: a significant portion of the market was not buying Bitcoin. It was borrowing conviction. Traders were using 5 to 10 times leverage on long positions, betting on continuation of the recovery from the 60,000 lows we saw earlier this month. When the tariff headline dropped and price moved even slightly against those positions, the exchange liquidation engines activated. And liquidation engines do not have opinions. They do not care about your thesis. They are algorithmic, they are mechanical, and they are ruthless. Each forced liquidation pushes price lower. Lower price triggers the next liquidation threshold. The next liquidation pushes price lower again. You get a cascade that looks on a chart like total collapse, but is structurally a derivatives flush and a clearing event, not a repricing event. The fuel for that move is leveraged longs. Once they are liquidated, the selling pressure from that specific mechanical source is exhausted. It is not infinite. It has a floor defined by the leverage structure itself. Understanding that boundary is the difference between panic and positioning. And here is what makes this moment even more structurally interesting. During this sell-off, short interest has built up aggressively on the other side. As price fell, short sellers piled in, borrowing Bitcoin to sell it, betting on further decline. What they have done, without knowing it, is load a spring. Because when price reverses, and the reversal catalyst in a market this oversold can be a single headline, a single Fed signal, a single institutional announcement, those short sellers are forced to buy Bitcoin back to close their positions. That buying drives price up. Higher price forces more shorts to cover. More covering drives price higher still. That is a mechanical short squeeze, and the conditions for one are more developed right now than at almost any point in the past year. Not a guarantee of timing. A guarantee of structural pressure building in one direction. Now cross-asset context, because I want you to see this move in proportion. Gold up 2%. Dollar index weakening. Emerging market currencies under pressure. S&P 500 absorbing the tariff news but not breaking. What you're watching is a textbook risk-off rotation. Capital moving from high volatility assets toward perceived safe havens during a moment of acute macro uncertainty. Bitcoin in this rotation is being treated as a risk asset. High beta, volatile. Sell first, ask questions later. And here's the critical tension that defines the entire medium-term investment case. The classification is increasingly inaccurate, but institutional capital has not fully repriced for the new reality yet. The attention economy, where large allocators mentally categorize Bitcoin, is lagging the on-chain and network reality by roughly 12 to 18 months. That gap between how Bitcoin is being priced and what Bitcoin actually represents in a portfolio context is the opportunity. But it only pays if you are still in the position when the repricing happens. Let me show you the capital flow fair value picture, because the number 64,000 feels meaningless without context. Spot Bitcoin ETF assets under management dropped from approximately $125 billion to around $94 billion over the past several weeks. Single-day outflows hit $133 million on February 19th. That is real selling. That is real pressure. But model-forward institutional allocation based on announced mandates, the regulatory clarity that now exists, and the historical lag between regulatory frameworks becoming established and actual capital deployment completing, and you get a probability-weighted fair value range that sits materially above current price on virtually every serious institutional model. Not because analysts are optimists, because the capital that has been greenlit to enter this market has not yet entered. ETF redemptions are one flow. Sovereign and institutional allocations in pipeline are a completely different flow, larger by orders of magnitude, slower to move, and almost entirely insensitive to a week of tariff headlines. Sovereign wealth fund assets under management globally exceed $40 trillion. A 1% allocation from that pool is $400 billion of potential Bitcoin demand against a current total market cap of approximately $1.3 trillion. You do not need a high probability of sovereign allocation to have a dramatically high expected value impact on price. You need a non-trivial probability. And in the current regulatory environment, with U.S. market structure legislation advancing, MiCA in implementation across Europe, and multiple Asian jurisdictions actively competing to attract institutional crypto infrastructure, that probability is not trivial. The regulatory timeline that was the primary gating factor on institutional allocation 2 years ago has largely resolved in the direction of clarity. What remains is the capital mobilization lag, the window between regulators opening the door and the capital actually walking through it. We are in that window right now. It is uncomfortable in the short term. It is precisely where you want to be positioned on a medium-term basis. Now, let me give you the statistical convergence data, because feeling your way through this market is how you lose. You need numbers. At the peak of the selling panic earlier this month, realized losses, meaning the actual dollar value of Bitcoin sold at a loss each day, were running at approximately $1.24 billion per day. As of the most recent on-chain data, that figure has compressed to approximately $480 million per day. That is a 60% reduction in daily realized loss intensity over a 3-week window. In statistical terms, this is convergence toward a mean. The market is in the process of establishing what analysts call a distribution low, the point at which the sellers who needed to exit have largely done so, and the buyers who see value at these levels begin absorbing supply faster than new selling emerges. This pattern, declining realized loss intensity over a multi-week window, has preceded the base-to-recovery transition in multiple prior cycles. It is not a magical signal. It is a statistical tendency with a consistent historical track record, and right now it is pointing toward exhaustion of the primary selling wave, not acceleration of it. The long-term holder cost basis data reinforces this. Holders who have held Bitcoin for more than 155 days, the cohort that has been through at least one prior major correction in this cycle, have a blended cost basis in the $40,000 to $50,000 range. Historically, Bitcoin price has not sustained levels materially below the long-term holder cost basis for extended periods, because those holders represent such a dominant proportion of existing supply that liquidity effectively disappears below their cost basis floor. The mechanism is supply inelasticity at the downside. Does that mean it cannot wick below 50,000 briefly? No. Wicks happen in this market. They happen fast and they recover fast. What it means is that the probability of a sustained multi-month price below the long-term holder cost basis is structurally low. Not zero, but low enough that the risk-reward calculation at current prices looks fundamentally different from what the sentiment data would suggest. Now, institutional psychology, because understanding who is selling is as important as understanding how much. When a Bitcoin ETF records $133 million in outflows in a single day, who is actually selling? Behavioral finance research tells us that investors feel the pain of losses approximately twice as intensely as the pleasure of equivalent gains. A 47% drawdown from the peak does not register as a normal correction to someone who entered at the peak. It registers as catastrophic, even though it is entirely within the historical range of Bitcoin cycle corrections. The sellers driving ETF outflows right now are overwhelmingly loss-averse recent buyers, people who entered somewhere in the 80 to 125,000 range during the momentum phase, who have now hit a psychological pain threshold and are exiting to stop the emotional bleeding. That is a finite and self-depleting supply of motivated sellers. The on-chain data from Glassnode confirms this directly. Large holder exchange inflows are dominated by shorter duration addresses, recent buyers. The long-term conviction holders, the people with cost bases in the 30 to 50,000 range, are showing essentially zero net selling behavior. The ownership structure of this market is bifurcated between recent entrants in pain and long-term holders in patience. And recent entrants, by definition, have a finite amount of Bitcoin to sell. Let's map where we are in the long cycle, because without this, your time frame is wrong. We are 16 months into a Bitcoin halving cycle that began with the April 2024 event. The halving reduced daily new Bitcoin issuance by 50%. In the short term, the market anticipates and largely prices in the halving before it happens. The real supply shock impact manifests with a lag, because reduced issuance compounds over months and the demand catalysts of each cycle. In this cycle, that means spot ETF adoption, institutional allocation frameworks, and potential sovereign acquisition interest take time to fully materialize and intersect with the tighter supply trajectory. Historically, the period between 12 and 24 months post-halving has produced the most significant price appreciation of each cycle. We are currently inside that window. The long cycle model does not tell you what happens next week. It tells you what the macro setup looks like over the next 6 to 12 months. And the setup is structurally consistent with prior cycles at this stage, with the additional layer of institutionalization that makes the demand side of this cycle qualitatively different from 2017 and 2021. And now the macro tariff reality, cleanly. Section 122 of the Trade Act of 1974 caps tariffs at 15%, which is exactly where Trump maxed out. It requires congressional review after 150 days. It is more legally contestable than IPA was. The tariff ceiling is defined by the statute. The escalation pathway is constrained by both law and political economy. For Bitcoin specifically, tariffs do not touch crypto directly. There are no customs duties on digital assets. The transmission is indirect: risk-off sentiment, inflation expectations affecting Fed policy, and the fiscal dynamic. That fiscal dynamic is the one that matters most on a long horizon. If tariff revenue disappoints relative to projections, which Goldman Sachs and other institutional analysts are modeling as a realistic outcome, the government faces an even larger deficit than the current trajectory implies. Larger deficits historically require accommodation. Accommodation historically dilutes the purchasing power of the currency, and hard assets with fixed supply schedules, Bitcoin being the most precisely supply-constrained asset that exists, historically benefit from currency purchasing power dilution. Matthew Sigel at VanEck made exactly this argument when the court ruling came down. The headline causing Bitcoin to sell off today may contain the macro argument most structurally supportive of Bitcoin on a 2 to 3 year basis. The market is pricing the sentiment. It is not pricing the fiscal consequence. Let me close with the only thing that actually matters. What you're watching right now, $64,000, 47% off the high, fear and greed index barely above 10, Google searches for Bitcoin Zero at record highs in the United States. This is not a new story. This is Bitcoin's story. Every cycle, every time. The mechanism is always slightly different. The derivative structure, the macro overlay, the regulatory moment, those change. What does not change is the emotional architecture of the bottom. Maximum pain, maximum fear, maximum certainty among the loudest voices that it is over. And then, not immediately, not on a schedule you can trade precisely, a recovery that punishes everyone who let the emotion make the decision. The people who search Bitcoin Zero at the bottom are not the people who end up profitable. The people who understand the derivatives flush, who model the capital flows, who read the realized loss convergence data, who track the long-term holder cost basis. Those are the people who have the framework to act when the emotional pressure is designed to paralyze. Trump's tariffs created a real short-term shock. The risk-off rotation is real. The leveraged long liquidations were real. The ETF outflows are real. Every bit of the pain is real. And none of it has touched the supply schedule. None of it has altered the halving cycle position. None of it has reversed the institutional regulatory clarity that took 3 years to build. None of it has changed the long-term holder behavior. The headline and the market reality are two separate things operating on two separate time frames. Your job is to hold both simultaneously and not let the shorter one destroy your position in the longer one. That is the framework. That is the analysis. I hope it changes the decision you are about to make. Share this with one person sitting in loss right now who needs to see the machinery instead of just the price. Because information quality, not luck, not timing, not some secret signal, is what separates the people who survive these cycles from the people who exit at the bottom and never come back. See you in the next one.